Howdy, Jacob here. Today we'll be looking at Black Hills Corporation as the next company in our dividend stock screener. So, initial looks 13 PE, 1.1 price to book. It's a multi utilities company for electric and gas utilities. They're $3.5 billion market cap, 6.7 enterprise value. So, quite a bit of debt, as we can see. From initial look at dividends, it is a 4.88% yield, and they've been consistently increasing it year over year. I guess we'll just have to see if they can afford this. It looks like from the earnings per share, it looks like they can afford it. What about their cash flow? Not so much. Okay, so looks like they're paying out about 166 million in dividends, and they have not had a year one. They've had one in the last 10 years that can actually afford this. So we can see that they're issuing debt just to afford paying this dividend. And as I've said in the past, companies that have to issue debt to pay out a dividend is not extremely sustainable. So I don't see the longevity of this. Their property plant payments are just massive. It seems like the more money they make, the more they have to spend on their assets just to maintain them, which is not what you want. That's not the best type of business to be in. Look, they've gone from 939 mil to 3.6 billion. That's tough. Okay, so I guess we can get to some assumption settings. Revenue. It's looking like it's growing pretty consistently. Well, not consistently, but it's growing a little bit. It's 30%. Was that an acquisition? No. Oh, that's a lot of growth. Could be inflation related, maybe. I don't know. Let's do 13. Don't see any premium necessary with a 3.5 roughly return invested capital. Besides this year, their operating and gross margin have been pretty consistent. Mid-30s for gross margin, low 20s operating margins. So let's see what we see for net income. What is this averaging? 12. I'm good with that. But then free cash flow, we're just not getting any because they're spending so much to maintain their property, plant, and equipment. I guess just 6. We'll see how it looks. A company's earnings isn't where they're paying out their dividends, it's through their cash flow. And so, although their earnings look great and everything, their cash flow is just not making up for it due to how much they have to pay to maintain this business. So I don't see how this dividend is staying, but just for the purpose of even this video, I'll just say that it's not going to change, and it's just going to be the $2.50 that it is right now. Even still, it's nowhere near a price to get a 15% return. So, 1, I just don't think it's the right price. 2, again, this whole screener is for people that want to make excess cash flow outside of work, or more specifically, if they were retiring and needed that extra income. This is the screener that I'd hope that would be helpful for them, and I just don't think this dividend is as sustainable as so many other companies with 4% or greater yields. So, all right, I hope everyone has a great rest of their day. Thank you.